Hello, world. Welcome to the QuantStreet's News and Analysis podcast. This is your host, Mahir, welcoming you to the latest episode of this podcast. Good morning, good afternoon, good evening from wherever you are listening. Today is Saturday, August 22nd, and here are the major economic updates for today. US national debt is now over $26.6 trillion by WWS Swiss Financial Consulting. The debt to GDP ratio is now standing at 136%, and the actual federal deficit is $3.95 trillion. The net interest on the debt is $337 billion. At present time, the debt to GDP ratio is like that of Italy, which was 135% in 2019 and is expected to reach 155% in 2020. The GDP for 2020 will likely be less than that of 2019, which was $21.4 trillion, and it's likely to be under $20 trillion, given the results of Q1 and Q2 so far this year. Investors should take into consideration that low Fed rates have resulted in extremely low yields on treasuries. This is one reason why investors have turned to high-yield bonds in order to get some return on their capital despite the higher risk of default. Even investor-grade bonds yield less than the usual due to the Fed policy of zero interest rates and even negative interest rates. So investors are pushed to increase their risk quotient. This is one reason why the stock markets are more attractive, as they have potentially a much higher return on investment than fixed income. One problem with the stock markets is that they are currently disconnected from the real economy. The US is in recession with extremely high unemployment. Lockdowns have driven many small businesses to the brink of failure. Civil unrest has wiped out thousands of small businesses. And the hospitality sector has suffered tremendously while airlines are struggling to survive. Many workers can barely pay their bills and are dependent upon government support. This is common knowledge, yet the stock markets have reached new highs after fully recovering from their March lows thanks to Fed's liquidity injections into the financial sector. Investors should reckon that in a high debt environment, the element of risk is higher. Given that the COVID-19 pandemic has caused panic among politicians that have overreacted by closing down the economy, investors have to be especially cautious regarding their investments. Warren Buffett dropped his airline stocks and took a loss. Investors should be prepared to take a loss in certain sectors in order to avoid even bigger losses in the future. It seems that the bulls are running the markets at present time, and some analysts see the S&P at 3750. It is better to be cautious in case the stampede changes direction. Our next update is about Q3 GDP forecasts. The numbers are out, and this is from Calculated Risk. From Merrill Lynch, the second quarter GDP is likely to be revised up to minus 32% quarter on quarter in the second release, and we are tracking a 17% for third quarter GDP. That's an estimate as on August 17th. From the New York Fed nowcasting report, it says that the New York Fed nowcast stands at 14.6% for third quarter of 2020. And from the Atlanta Fed, the GDP Now model estimates the real GDP growth in the third quarter of 2020 at about 25.6% on August 18th, which is down from 26.2% on August 14th. It is important to note that GDP is reported at a seasonally adjusted annual rate, or SAR. A 15% annualized increase in GDP is about 3.6% quarter over quarter. Also, a 15% annualized increase would leave real GDP down about 7.5% from Q4 2019. The next update is about conflicting treasury market signals which keep investors guessing. This is from James Picerno of Seeking Alpha. Depending on the slice of the treasury market, inflation expectations are rebounding or the outlook for economic growth is weakening. One of these implied forecasts is probably wrong or at least less useful for estimating future macro risks. Higher inflation and softer economic growth is impossible. Think stagflation of the 1970s. But it's not yet obvious that conditions that produce that malaise are recurring, and so the odds still favor one scenario at the expense of the other. The recent surge in personal savings rates suggests that consumers are banking government payouts rather than going out on spending spree. US retail spending has bounced back, and in July, sales rose above their pre-coronavirus peak. Payrolls are also recovering. although the huge increases in jobless claims every week are a warning sign that the labor market remains vulnerable. For some analysts, the possibility that inflation will soon rise, forcing the Federal Reserve to raise interest rates, if only slightly, animates certain corners of the investment community. As a market signal for monitoring the central bank's willingness to lift rates, keep an eye on the 2-year Treasury yield, which is widely viewed as a gauge of market expectations on policy changes. Economic data will likely determine what happens next. Unfortunately, the level of uncertainty is higher than usual thanks to coronavirus. Although the macro trend overall continues to reflect a rebound persisting in July, all eyes are turning to the incoming August data as a stress test. The key question: has a new economic expansion started, or is this a dead cat bounce? The updates in the weeks ahead may provide some much needed clarity. And our final update for today is about the flood of US Treasury issuance and duration supply continues. It's by Hong Shi of S&P Dow Jones Indices. In the Q3 2020 refunding statement released on August 5th, the US Treasury announced its plan to increase auction sizes across all nominal coupon tenors over the August to October quarter, with larger increases in longer tenors, the longer tenors being 7-year, 10-year, 20-year, and 30 years. Since March 2020, the Federal Reserve has stepped into a broad array of actions to limit the economic damage from COVID-19 pandemic, including the resumption of security purchases. As a result, the Fed's aggressive purchases are not immediately easing pressure on long-dated US Treasury yields. Since the refunding announcement to August 14, 2020, the end of the week that included these auctions of 3-year, 10-year, and 30-year US Treasury bonds, 10-year US Treasury yields went up by 16 basis points, while 30-year US Treasury yields rose by 23 basis points. Weak demand for the record-sized 30-year US Treasury bond auction on August 13 may indicate an early sign of indigestion. At the same time, a short position has been built up as Commodity Futures Trading Commission data shows net non-commercial positions in long bond futures 15 to 25 years as of August 11th were at a record high level since year 2000. This has been your QuantStreet news and analysis briefing. Check back later on this channel for more such stories and updates. Thanks again for listening. If you enjoyed Thoughts on Economy and Markets, please take a moment to rate and review us on the podcast app of your choice or YouTube and help more people find the show. Have a great day.